Yeah, thank you, Prabhu, for the introduction and good morning to everyone. And thank you for joining us on this Saturday morning. Just a quick disclaimer before starting the webinar that whatever the stock ideas theme that we'll be discussing today, so it's only for the educational purpose and do your own research before investing in those themes and ideas. So starting with with a quick review of FY26. So FY26 ended on a very shaky note. The market dropped by around 11% in the month of March, mainly due to the escalating US-Iran conflict. So FII selling and the currency weakening were the key triggers for the market to correct heavily during the month. And what we have also seen that it was a month in which rupee has moved from 92 to 95 mark. Crude has gone up from 76 to let's say $120 per barrel mark. And then India VIX has moved from 13 to 25 level, right? Which indicates the volatility in the Indian markets. So we have seen that again going up to 25 after 3 years. And then FII outflow was to the tune of around 1.2 lakh crore in a single month. And our oil bill to GDP ratio, oil bill as a percent of the GDP was around 3%, which has moved up to 6% during a single month, right? So, so overall, the deteriorating fundamentals because of the macro overhang led to the sharp weakness in the market, and there was quite a panic on the street, and we have seen a lot of MTF book also unwinding during the month. So, for example, at the beginning of the month, it was roughly around 1.2 lakh crore of the MTF book, which has come down to around 1 lakh crore now, right? And also, what we have seen is that because of the challenges being faced by certain industries, mainly coming from the fertilizer side or tiles, or let's say certain select industries which are facing pressure because of the LPG shortage and urea shortage. So their government are focusing their efforts to promote this safeguard the small businesses and take necessary action to support the economy in these turbulent times. But whenever there is a panic, it's very important to also relook at what has happened in the past when there were similar situations. Maybe not the exact trigger point, but when there was widespread panic on the street and how the market has performed, right? But just to quickly recap, last 2 year return of equity market has gone down to 0% down, right? Nifty was 0%. Small cap is also currently 0%, has delivered 0% return in the last 2 years. The good thing and the surprising thing was that the small cap is the best performing of the lot in the last 1 month, right? When the most of the carnage has taken place, right? So small cap index was down around 10%, Nifty was down around 11%. So overall, what we have seen is that currently we are in the 18 months of this bear market. Small caps and mid caps have completed their price correction last year, right? Between January to March, and after that, for the 9 months, they were in the time correction mode, and from January to March again, we have seen a heavy price correction happening into the Indian markets. And this time, large caps have also participated in the fall. And normally what we have seen is that whenever the last leg of buyer also comes and sells, that's typically the end of the bear market. So for example, in the last fall, what we have seen last year is that let's say mutual fund or the institutional players have rebalanced out of the small and mid caps to the large caps, right? So that was the segment which has not fallen. On the 1st of January or 2nd of January, the market has made a new all-time high as well. But now that everything is down, Nifty is down, let's say around 16% from the highs, and blue chip names like Reliance, HDFC banks are also down more than 50%, 15% from their highs. So it means that there is no hiding space in the market today, and there is a widespread fear on the streets. But what the index is showing, like in terms of fall, if you look at the 1 year fall is around 5.5% for the Nifty and similar around the small cap. So this 1 year fall by the index is masking the true sort of carnage that has taken place across the broader market. So Prabhu, if you can move to the next slide, please. Yeah. So this is a data of 2,400 all companies compiled as on 23rd of March. So what it basically shows that only just 5% of the companies have fallen lesser than 5%, right? While if you look at more than 60% of the companies have given a drawdown of more than 30%. It means that indices are not representing the true picture, and there is a widespread panic on the street. People are exiting their equity positions or are forced to exit their equity positions because of the leverage they have taken in the markets. So clearly, the valuations are at rock bottom if you compare by any yardstick. If you compare the current valuations to the long-term averages, we are clearly trading at a discount across many parameters today, right? But it's also very important to look at what how we have behaved in the past when or how the market has delivered returns in the past when such carnage has taken place. So let's relook at the numbers, right? For example, Nifty has just in this financial year, FY26 Nifty has ended around 5%, right? Whenever, in the past 20 years, there were just six instances in which the Nifty has given negative returns. And, every subsequent year in which the Nifty has given a negative return, the market has delivered positive return, right? So for example, FY 2009, when the index was around 36%, 2010, the index had delivered 73% return. In FY20, when the index was down around 26%, the index delivered 70% return in 2021, right? So the odds are in the favor of investors today, right? Going by the historical trend that we have seen, that every financial year in which the index has delivered negative return, the subsequent reward year are very rewarding for the patient investors and the courageous investors who remain invested in the market. Now, moving on. There is also a bit of seasonality in the market because of which, we have seen the excessive downfall today, right? So, for example, this quarter four and January, February, March month are the months typically in which, the index tends to go, lower than the rest of the quarters, right? So, we have compiled the data of again 20 years to see how the seasonality, behaves. And because of the liquidity crunch in the economy, right, a lot of investors have to go for advanced tax filing and then tax loss harvesting and all sort of things. So the index remains under pressure because of that, right? But subsequently, if you look at April is the best month for the market, and subsequently the next 6 months are in the odds are in favor of the investors who remain invested or try to do a top up in the markets. And today also what we believe is that the intermittent bottom, or we are very close to the intermittent bottom of the market. And from here on, there is a relief recovery or rally which is at play, and we'll be seeing a benefit of that for investors in the coming months and quarters. Now moving on. The main reason for the fall in the market was the spike in the crude prices. As a net importer of crude, we import roughly 80 to 85% of our crude requirements. So mainly any sort of volatility in the crude price is a trigger for the economy to go under a very short-term shock. But historically, whatever we have seen in the past is that post the correction, the markets are actually quite buoyant over the next 1 year or so. For example, when there was a crude shock in 2008 to 9 after the global financial crisis, what we have seen is that the Nifty rebounded around 74% from March 2009 to March 2010. And during the Arab Spring, when again one of the parties to the conflict was Iran, and there was again some bit of conflict happening around the Strait of Hormuz. So again, there was a correction and the crude rallied similar to this time also. The last time as well, the crude rallied to around $118 dollar mark. But subsequently, what we have seen between March 13 to 14, the Nifty rebounded by around 18% in a year. Also, if you look at between 2017 and 18, when there was a oil rally to $85 mark, uh, again, for the subsequent year, the Nifty has given a 15% return. And very recently, Russia-Ukraine war, when again crude rallied to $120 mark. So we have seen the index to rally around 28 to 30% in the subsequent year. And this is just the rally in the index, which is Nifty, which is the most conservative index in terms of risk reward. The aggressive part of the market, which is the mid and small caps, have delivered a much higher return in the subsequent years. So the takeaway is that this volatility is a ideal time for the investors to do a top up into the market. It doesn't changes the fundamental. It doesn't deteriorates the fundamental for a long period of time. But very short term, there is a fear on the street which leads to a lot of selling, which is ideal time to accumulate as well. Now moving on. What we have seen during the period, right, during the previous wars, is that between the Iraq War, Kargil War, when there was a World Trade Center attack, and then very recently, in 2008, there was a Mumbai attack, and very recently Pulwama or Russia-Ukraine war. So the war is a trigger for the markets to correct, right? There is a lot of uncertainty around around the extent of duration, like how long, for how long the war can get extended, and then there are oil shocks and recessionary fear as well, and the market reacts to it, right? And we see in a very short term there is a correction on the streets. We have compiled a list of a table of past corrections. But subsequently, what we have seen is that the correction duration lasts only between 3 to 4 months on an average. And the return from the bottom is very rewarding for the investors. For example, the Nifty has delivered an average return of 16% in a 1 month, and let's say 27% to 38% return over the period of next 2 to 3 months. Right. So again, these are past analysis that we have done. It doesn't mean that this time also it will be similar, but it's just an indicative number that investors can look forward to. Now moving on. Again, this is a number which is very important whenever there is a large spike in crude happens, right? So what we are seeing today is that Nifty to Brent ratio has actually plummeted, right? It means that the Brent has rallied from 75 to 120 mark, while the Nifty has gone down from 26 to 22,000 level, right? It means that the equity market is clearly oversold, and whenever we touches the lower half of the bottom, right, which is around 1.5 to 2 mark of this chart, then we see a sudden recovery or very swift recovery in the market happening. There could be a trigger for it. Either the crude comes down to the level of, let's say, 70 to 80 mark, or let's say the Nifty goes up by 12 to 13%, right, in a very short period of time. So that will again lead to a recovery in this chart we are seeing currently, right? So from here on, either of the two instances will be the positive for the broader market, and we remain optimistic for that to happen in the near term. Yeah, Prabhu, if you can move to the next slide. Okay, so in between, all those negatives that has happened in the market in the last 3 months, starting with the U.S. Venezuela crisis, and then AI related sell off, and very recently, this Iran US war. So these are the key negatives which has masked the good things that we have seen in the previous 9 months, right? For example, the government capex remain robust. The private capex is coming back at play, and we have seen it improving in the first 9 months. The credit growth for the last fortnight of 2026 was at around 14 to 15%, and it continues to be stronger in the first 2 months as well, right? Very important to see how it pans out for the last for the last month and this month as well. But the credit growth has started finally to come back because of the liquidity measure government of India as well as the RBI has announced. And also what we have seen is there was a sequential recovery in the corporate earnings, right? So for example, the earnings bottomed out in the Q4 of FY26, but now that in the last 3 quarters, we have seen a sequential recovery in the earnings happen. And very important to see how the earnings hold up in this excessive volatile quarter that we're currently going through. Also, we have seen the recovery happening in the BSE 500 as well as the broader market, and the earnings for the small and mid caps were very comforting, and were to the tune of 20 to 25% for the mid and small caps. So that were key positives. In the short term, market can deviate from the earnings growth trajectory, and because of the excessive fear that we see. But in the long term, the primary driver of the return is the earnings growth. And as long as we are seeing the rebound in earnings growth happening, we are very comfortable that the price will also rebound and it will catch up to the fundamentals. Now moving to the next slide. So just a summary of some 3 4 key risks that has happened in the last 1 month. So because of the rise in the crude prices, we may see the CPI and the WPI basket to go up a bit. The numbers print in the upcoming month to go up a bit. Maybe WPI could rise from 0.7 to let's say 1%, and retail inflation can go up by 0.5 to 0.6%. Also the because of the rise in the crude prices, we can see the current account deficit to widen by, let's say, 1.3% for FY26 to 1.6% to 1.7% for FY27. So that could be a net impact on the current account deficit, because every $10 a barrel rise in the price leads to $30 to $20 of extra crude bill, right? So that can lead to widening of the current account deficit. But again, it's very manageable number that we are seeing even with the elevated crude prices. Lastly, we can see some currency pressure, but thanks to the intervention of the RBI, right, we have seen the currency to come back to again 92 level. So it shows the intent of the RBI as well as the government to take all measures necessary to curtail the the depreciation of the INR and to curb the speculation which is happening on the economy. And lastly, on the monetary and policy front, so maybe we are factoring in one more rate cut for this quarter. Maybe that has got a bit delayed because of the rise in the crude prices. But it's important to also see maybe whether RBI can go for a rate hike or will be going for a rate hike in the later part of this year or not. But overall, we see the market government to be very supportive to the economy, and very recently they have come up with a credit guarantee scheme of 2 lakh crore to spur the and to to support the MSMEs part of the economy, right? So we see those sort of positive steps to be taken by the government as well in the near future to support the economy going forward. Yeah, Prabhu, if you can just move to the next slide. Yeah. So again, on the FII side, we have seen a very heavy selling, but India is not the only country where we have seen. In fact, they are selling from the entire emerging basket. So in the last month, they have sold close to $50 billion of equities. Roughly 20% of it has come from the Indian markets. But if you look at the ownership today, it's roughly in the range of around 16% of the Indian equities. And now that the currency has come back to the 92 level, we see that number to whatever the FIA outflow we have seen in the month of March, that number to be in the sideways for some time, right? At least we have seen the worst of the outflows, and going forward we'll not be seeing that much outflow in the over the next 2 to 3 months at least, right? And again, the good thing that the market is not pricing is that we are moving like. This India US trade trade deal that has to happen in the month of March, so that got postponed a bit. But if that has to happen, that will again be a trigger for the FIs to come back and rebuild their position in the Indian markets. So those are again the key positive triggers that we are watching out for in the coming quarters or so. Now moving on. So again, a brief snapshot of the companies that could be impacted, right? So we remain very optimistic on defense because of all the actions that has been taken place in the Middle East and the GCC countries. So it creates export opportunities for all the defense companies. In fact, yesterday the export data has come in for the defense, and we have ended the year with 64% increase in the defense, right? Exports. So defense remains one of the key picks and a very a near-term trigger for the market to also reward it. Again, the oil exploration companies and the upstream companies on the oil side, so they remain very optimistically placed in the current market situation. Shipping companies and the consumer discretionary companies also remain favorably placed. On the neutral side of it, auto, banking, insurance, hospitals, pharma, capital goods, and metals, these companies remain neutral placed, and these companies don't see any major impact happening because of the elevated crude prices or the Middle East situations. And the companies which are negatively impacted are the OMC companies which are dependent on the crude derivatives as a input material like chemicals and fertilizers, paints, aviation, and Gulf link export companies. So these are some of the companies which will remain negatively impacted. So we remain very vigilant on development of how these things. And as of today, we have none of our companies, portfolio companies, are placed in the negatively impacted segment. Maybe one or two company, and again, there the companies are taking measures to discount those negatives, right? So they are either going for the price hike or they are taking steps to secure the availability of raw materials. So we remain very optimistic on the portfolio that we are running today, that these companies will not be negatively impacted because of whatever the situation is there in the Middle East. Now moving on. Yeah. So just to discuss key risk, I think this slide we have discussed in the previous Alpha Stories webinar as well. So we have highlighted some six key risks for the near term, and in fact, three has already played out. So we have highlighted that in the yellow, right? For example, the Iran-US war spillover has already taken place. Global AI-related sell-off in equities has also happened in this month. For example, we have seen the sell-off happening in the Korean market, Taiwanese market, and the Japanese market. And we have also seen sharp depreciation happening in the USD INR pair, right? So those triggers have already placed. The good thing is that market is down 11%. So going forward, will not be reacting to those negative triggers much. The other part to it is that we have yet to see the quarter four earnings, and there could be some moderation in the earnings expectation, right? So we have to see how the earnings for the H1 2027 plays out, and also this the inflation spike that we are seeing because of the elevated crude prices. So how what could be the policy response from the central bank to this elevated crude prices and the inflation shock? So those are the key triggers that we'll be watching for over the next 2 to 3 quarters, and we'll be positioning our portfolios accordingly. Now, coming to managing risk, so very important for any top up that's coming to the market or any sort of new investments that's coming to the market, right? So very important to rebalance out of the underperforming businesses of the past. Also, we have to avoid the pockets which are clearly hyped by the market, right, in the past. So we have to focus, while identifying the new businesses, we have to focus on the fundamentals of the companies and see, in this turbulent times, if the situation can persist for longer, whether these companies can, deliver higher earnings growth versus the index in the coming years. So that's the hallmark for investing in today's time. And let also look for new businesses where we can have some bit of earnings tailwind. So I think we have compiled a section where we'll be discussing those themes that my colleague Vijay will be discussing with all of you. So yeah, that we'll be focusing on that as well. Now moving on, just to capture finally about the earnings for the overall market and the portfolio. So on the overall market side, if you look at all the indices have come down below their long-term averages, and this is again by any standard a very good time to deploy money in the markets today. Historically, what we have done, and we have done an analysis as well, that whenever the Nifty 50 P reaches below 20, the forward returns for the Nifty is rewarding for the investors, and whenever it goes up to 24 or higher than that, then the forward returns are actually compromised, and it's on the lower side. So very good time to start putting the money, or if you are invested, remain invested in the market, because the valuations are clearly trading at a discount for all. Just we are receiving also a lot of questions on what could be the earnings impact because of the current situation. So maybe we have a total profit pool of 15 lakh crore. 6 lakh crore is from the bankings and financials. Basically, financial services contribute 6 lakh crore to the profit pool. 2 lakh crore is coming from the IT side. Manufacturing mainly towards the MSMEs and companies like tiles, pipes, tires and all. So these manufacturing names contributes roughly 1.5 lakh crore to the profit pool. Even if we take a 35 to 40% hit, so we are roughly coming up with a number of 50 to 70,000 crore. That's the overall impact on the earnings on a profit pool of 15 lakh crore, right? So if we have to quantify that number, it's coming around 5 to 7%. So because of this overall conflict that we are seeing, the earnings impact is in the range of 5 to 7%. While the markets are down 10%, it means that the fundamentals have become attractive for the markets, and the market is actually punishing each and every sector which has nothing to do with Iran-US war. So clearly it's in a fear mode, and it's in a sell-off mode, and the fear is there on the street. That's why it's happening like that. But again, in the high side, 2 years down the line, it will be again one of the best opportunities to put money at work, to put money at investment. So that's the key takeaway for us in this slide. Now moving on, just to recap, what we have seen in terms of earnings growth for our portfolios. So all the portfolio, in fact, including IBL, FlexiCap, Super Value, and Aggressive, has continues to deliver higher earnings growth on a year-on-year basis for our portfolio. So we have delivered higher revenue growth as well as the higher earnings growth, and we remain optimistic that the kind of portfolio that we are running, the themes that we are running, will continue to outperform the indices. So now, my colleague Vijay will discuss the key themes and how we are managing the portfolio with all of you. So yeah, over to you, Vijay. Now, thank you.
Yeah, thank you, Prabhat. So we'll begin with the next section. Yeah, yeah. So as my colleague has highlighted a lot of stuffs on the recent market side, so we'll move to the next part. We will be discussing the themes for the next 5 years. But before that, as we are transitioning from $4.5 trillion economy to eventually $10 trillion in upcoming 5 to 10 year of period, so there are several key growth drivers that we need to focus on And based on that, we will be able to identify certain themes which can outperform the overall market. So we listed around seven major key growth drivers as listed like one of them is the government capex, PLI, expansionary policies, energy transition, China plus one, financialization, saving, and rising per capita. So if we look at the some of the key like drivers in terms of let's say government capex, so government has been very keen to push the capex side on the domestic side, and they increased it to 12.2 lakh crore in the FY27, marking 9% increase versus the FY26. And we expect it to grow in the same trajectory, tracking the GDP growth, nominal GDP growth rate of 9 to 10% over the next 5 to 10 years. The second thing, which is the PLI, which is a production linked incentive scheme, which was launched around 5 to 6 years back. So it has attracted around 2.16 lakh crore of investment by the private players, and it has generated around 20 lakh crore of cumulative sales in last 6 years, and it has also generated 14 lakh direct and indirect jobs, and the government has already disbursed around 28,000 crore of incentive linked to the sales that the private sector companies have laid out. And recently the ECMS, which is the Electronic Components Manufacturing Scheme, it has also the government has also doubled the capital outlay, starting incentive outlay from 22,000 crores to 40,000 crore. So it is a major boost for the domestic manufacturing. We see it a very let's say outperforming in terms of earnings over the next 5 to 10 year period. Third is the expansionary monetary and fiscal policies, like in terms of like GST cut or maybe RBI response on the monetary front side, or even the currently the NDF ban, which has happened on the non-deliverable forwards. So which has a major positive impact on the currency, because currency has been in the free fall for the last 1 year almost, and it accentuated in the last in this Q4. And RBI came up with this NDF ban, which is quite positive in our front, and maybe they can also go for additional measures if it's required to protect the rupee. Again, government has also done the GST cut in somewhere around the Q2 and Q3, which is also again positive for the next 4 to 5 year period. Fourth one is the energy transition. So as we are moving towards a clean energy push, and we have set the target of 500 gigawatt of energy by 2030 in terms of renewable energy side. So that is again a one key growth driver. Fifth is China plus one, which is the supply chain diversification from the global player side. So maybe moving from China to other countries like emerging countries like India, Vietnam, for the diversification of the supply chain. Sixth and seventh are linked to the basically the rise in per capita income. As the GDP grows up, there is a higher personal disposable income, and which leads to the surplus income, which typically is gone. It goes to the let's say the investment part of the portfolio, or it goes behind the discretionary consumption. These are the seven key growth drivers, and based on that, like now we will try to uncover themes one by one. And starting with the first one is the wealth management. There are overall seven themes, and first one is coming from the finance side, which is the wealth management. Of course, we like banking as well, but we think like there is a like banking has also kind of matured in terms of let's say the because of the vast penetration and already at the more than 200 lakh crore of credit portfolio. But if we compare the wealth management, so it is in very early stage of the long bull cycle. And if we compare it with the let's say the some of the listed like the developed markets, like if we look at the wealth to GDP, which is 6.5x for US and 4.5x for India, and also the share of financial wealth is around 25% versus the 70%, and the wealth which is managed by the professional experts is around 75% in US. In India, it's 15%. So there is a massive gap, and we think it will require at least 2 to 3 decades of consistent effort from the industry and also from the investor side for increase this 15% to eventually 50 and 75% in the once we become the developed by 2047, what government has been targeting. And we think like this sector will be like a biggest beneficiary of this GDP expansion. And even MFI has set the target of by 2047, the whole MF industry should be somewhere around 2,800 lakh crore, which is almost 50x jump from the 2024 base of around 50 lakh crore. Currently, we have already reached 80 lakh crore as of FY26 end. So it will be generating around 17 to 18% AUM growth. And typically the earnings growth for the wealth management companies or even AMCs are also in line with the total AUM growth, which is 17 to 80%, including the new money addition, which will be over and above that 16 to 18% of this thing. And of course, the brokers will be also beneficiary, but we don't like typically the brokers. We would want to play this wealth management journey ideally through the wealth management or the AMC play. So this is the first thing. Now moving on to the second one. Second thing is coming from the healthcare side. So if we look at the WHO mandate, so it explains that you need to have at least 3 beds per 1,000 population. And if we compare, if we look at the Indian infra in terms of health, so it is around 1.3 beds per 1,000 people. But of course, we have our limitations in terms of funding, and majorly like the private players are expanding the beds. So we will require certain 2 to 3 decades again time to reach from 1.3 to 3 beds. And even if you look at some of the developed players, so they have more than 10 beds per 1,000 population. So 3 is the minimum. We can go up to 5, 10 once we become developed. So there is a huge runway. So typically, if we look at the current, let's say the dissection of the current healthcare market, so we are around 25,000 hospitals from the public sector side, around 43,000 from the private side, and the beds are also like 7 lakhs to 12 lakhs from the private side. And we require around 24 lakhs additional bed. So we have currently around 19 lakhs beds, and we require around 24 lakhs additional bed to take it to the 3 beds per 1,000 people mark. And we think like it should happen mainly from the private sector heavy lifting side, because the funding availability is also there in terms of the private equity players, and also the lot of interest from the public sector side, like public participation through the QIP and preferential allotment. So we think like this theme has again the potential to deliver higher earnings growth over the next decade. Yeah. Next thing, please. So third theme is from the defense side. So again, there is a euphoria around the defense because of the current conflict happening in the Middle East side, and government is also planning to take benefit of it. And government has set the target of by 2029 that we should achieve the defense manufacturing around 3 lakh crore mark and 50,000 crore of defense manufacturing exports. And if we look at the total budget, which is around 7.85 lakh crore for FY27, and the capital outlay is around 2.1 lakh crore of 2.2 lakh crore of that 7.85, which is around 26-27%, and it has gone up by 21% versus the previous year. And we think that the overall defense expenditure will grow at 6 to 7%, tracking the real GDP growth rate. But the capital outlay, which is the components on the, let's say, buying new equipments and technology side, which will grow around 8 to 8.5%, starting from 2.2 lakh crore to almost 10 lakh crore, 10.5 lakh crore in by FY47. And the percentage share will also improve from 26% to almost 36% by FY47. So we think there is a huge room for the expansion in earnings of the defense companies. And as we see in the next slide, please. So in this slide, we can clearly see who are the, let's say, the biggest beneficiaries. So if we look at the export numbers, which recently came out from the government side, there was a jump of 62% in terms of the defense export side. But one clear thing, what we need to focus is that the DPSUs, which are the defense public sector undertakings, which has grown more than 150%. Okay, and the sales from their side has gone up from 8,000 crore to 21,000 crore. So clearly, the DPSUs are the largest beneficiary of this trend. If we dissect little bit, so the execution track record is very high when it comes to DPSUs, and again the execution capability is also very high. So that is why typically the DPSUs get preference when there is order book allocation from the government side, and even recently the Middle East conflict. So before that, like a lot of government companies had from the defense side have gone and participated into the defense expo. So there is also very like high interest from the Middle East side in terms of buying the, let's say, the anti-drone or counter-drone solutions from the Indian manufacturers. And some of the companies like BEL is a front runner for this kind of this thing. And of course, there are also a lot of private sector plays which can benefit out of this, but we typically prefer DPSUs when it comes to the defense. So this is again a theme with very long track record of execution, and again a very strong order book over the next 1 to 2 decades. Now moving to the fourth and fifth theme, which is a part of the discretionary basket. So basically these two themes, one is the fashion retail, another is the jewelry. which are coming from the higher personal disposable income because of the rise in GDP per capita. So if you look at the apparel market, so which was valued around 5.5 lakh crore, it is almost 6.5 lakh crore as of now, 6.5 to 7 lakh crore, and it is expected to reach around FY28 basically 10 odd lakh crore, 28 to 29. And government has been pushing a lot, and earlier till 1,000 rupees mark, the GST was around 5%, and now the government has increased that limit to 2,500 rupees. So till 2,500 rupees, the GST is only 5%. Beyond that, we have to pay around 18% GST. So government is clearly focusing on the value fashion side, which is basically catered to the lower and the middle income group. So we believe like the value fashion retails have the higher earnings potential to deliver, let's say, on the north of 13-14% on the next 4 to 5 year period. Moving on to the jewelry side. So jewelry market is somewhere around $84 billion in terms of the current size, and we are expecting it to reach around 28, 29, $145 billion, generating around 13 to 14% CAGR. From the 23, it will generate approximately 16% CAGR. So typical observation when the gold price goes up, so typical behavior of the consumer is to go for the lightweight jewelry or the lower caratage items and the stud jewelries. So what happens is typically demand gets deferred by 1 to 2 quarters, but once the wedding season comes, like currently the wedding season is going on, so people purchase the jewelries irrespective of the price, because that is how the consumption has been shifted over the last many decades. And what we have seen that typically the lower caratage and lower stud items have higher margins because of the higher making charges or the finishing which is required more in terms of the lower caratage side, and it puts let's say it basically culminates into the margin expansion for the jewelry players. And typically the jewelry players, which are the selling jewelries in India, they make profit by selling you the designs, which is you the making charges, and making charges are always as a percentage of the gold prices. So if we compare, let's say in 2002, when the gold price was around 4,000 rupees per 10 gram, and today is around 1.5 lakh per 10 gram. So at that time, let's say they were making at the 20% gross margin, let's say the making charges. So they were making 800 rupees for 10 gram. But today at 1.5 lakh, if they are charging around 18 to 20%, so they are making 30,000 rupees per 10 gram. So that is how the basically the margin, the gross profit works, and also the margin expense when the, let's say, the lower caratage items goes up. So this 20% GP margin, which is the goes up to 20, 22, 25 as well. That is how we see the jewelry industry to let's say expand in the next 4 to 5 years as well. And we think like this organized part of the jewelry, which is around 37%, will move to 43% in the next 3 to 4 years, and it will reach around $62 billion, maybe by 28 or 29, maybe 1 year extension due to this recent conflict, but it will decently outperform the overall jewelry market by 2 to 3 additional percentage points in the CAGR terms. So these are the two themes from the jewelry side. Now we'll move on to the sixth theme, from the discretionary side, we'll move to the next thing, which is coming from the energy push. So like in 2024, government mandated like we should have at least 50% renewable energy capacity. And today we have already crossed that 50% mark, and government is propelling the 500 gigawatt addition of the total energy from the RE side. We have already crossed 220. 105 is coming from the solar side. It will reach around 280. 47 odd is coming from wind side, which is again go to 100 in next 4 to 5 years. 46 from the hydro side, which will go to 70. And the government has also reduced the GST from 12% to 5% on the solar projects. So which is generating savings of around 20 to 25 lakh per megawatt. And it will total, if we combine this benefit, it will come to around 1.25 to 1.5 lakh crore for the players who are, let's say, pushing for the RE push. And recently government is also targeting to increase this 500 gigawatt target, 780 gigawatt, 786 gigawatt by 2035. So government is very keen, like the energy pie that India had currently becoming 50-50%. So it should eventually cross 60 to 60% mark in 2035. So government is also very keen. We need to reduce the reliance on the fossil fuel side and the traditional energy. And again, I think this current push from like the current conflict has also again pushed a lot of efforts to accelerate the RE push. So this is the theme, like we think like will continue to outperform in the next 4 to 5 years. Of course, the current beaten down valuations offers a lot of opportunities to grab RE players at a discount. Yeah. The last theme is coming from the EMS side, which we discussed, like the ECMS, electronic computer manufacturing scheme, which has almost attracted double incentive outflow from 22,000 crore to 40,000 crore. And if you look at the total size of the EMS in India, it's around 4 trillion, which is a 4 lakh crore. And domestic manufacturing pie is around 12 lakh crore, and total overall Indian electronic market is 15 lakh crore. So we expect this thing to compound more than 30% CAGR in terms of the EMS side, because we have a lower penetration of, let's say, the white goods products, let it be AC or the washing machine, refrigerator. And as the GDP per capita goes up, the income per capita goes up, and typically people start to purchase this thing, and the penetration versus the global players will go up. So this is a quite like outperforming sector from the future perspective. And from this side, but we like one particular theme on the ECMS side, which is basically the OSAT and the PCB. So basically OSAT is your outsourced semiconductor assembly and testing. And recently also our Honorable Prime Minister inaugurated one of the private players semiconductor facility in western part of the India. So this is a clear push coming from the government that we need to decrease reliance. And we have seen in the past as well, whenever some conflict happens and we get the reality check, so government pushes for the reducing the reliance on the external side and become self-reliant. So we think like this is a blessing in disguise if we look at the current conflict. And of course, we understand the pain that is happening because of the price fall and the fear in the market. But that is how the each bear cycle carries the seeds of the new bull cycle. And that has been the past, if we look at the last 10 to 11 conflicts, which has led to the massive bull cycles, like post Iraq war, we saw post Arab Springs, we saw. So these are the again the turbulent times, but it will offer a lot of good sectors at the discounted valuation. The last thing on the OSAT side, maybe on the next slide, please. Yeah. So currently, like we have like very small size of OSAT industry. If we look at in India, so it's just starting to build up. It's less than $50 million. But if we look at the global OSAT market, somewhere it's around $48 billion. And we think that we have a lot of room to grow. We will cross $200 billion, which is again very small if we look at the $48 billion, which will again cross $60 billion by 2028. So we think like India has a huge room to capitalize on this OSAT and the PCB market, which is growing because of the government push and reducing reliance on the external supply chain side. So these are the 7 themes in that we think from the next 4 to 5 years, because of the government steps that they have taken and because of the valuation correction that we are seeing. So right now, a lot of the prices of the stocks are not reflecting the fundamentals. They are sufficiently diverged. Of course, people are like factoring in the EPS cut, but that is not material. Maybe 1 year we will see 5 to 7% kind of EPS cut. But if we look at maybe FY28 or FY29, this thing, because the price have already corrected. So the bad part of the cycle has already been factored in. So once a little bit clarity emerges, even like Iran coming up with the toll system of $1 per barrel kind of transit charges, and typically countries like India and China and Pakistan have also got the free passage of the tankers, and we are seeing one by one our tankers are also coming. So we see like some improvement if the happens in the global macro side. So the themes which will have higher earnings potential will be leaping forward and outperforming in the upcoming bull cycle. So that is our hypothesis behind playing the next bull cycle. And if anyone wants to, let's say, play this wealth creation cycle for the next 4 or 5 years with us, so please reach out to us, and we'll be happy to help you on this journey. Yeah. So that is all from our side. And thank you for listening us patiently on this.